Hey guys, welcome back. Hope everything is going well and your accounting is going smooth as it can be. So today we're going to we've been looking at reports previously that we would do necessarily sometimes throughout the year, at the month ends and year ends. Today we're going to focus on actually getting the reports and adjustments that we need to do at the end of the year. So we're getting all those reports submitted so that we can get ready for taxes. So one we're going to look at today is we're going to look at closing entries and what that is. And then finally, we're going to look at a closing balance report. So that was something we could send off and make sure everything's ready for the tax man. All right, so let's do that now. Let's look at what a closing entry is. So closing entries are basically what we need to do is we're resetting the accounts. So all our temporary accounts, so revenue, expenses, drawings or withdrawals, are accounts that we need to reset back to zero so that when we start the next year, we're starting off fresh. All right. However, if you notice here, there's a new account that we haven't done, and this is called income summary. And the income summary account, what it is, it allows us to reset those to zeros because we can't just take and magically make them into nothing. So this account allows us to balance those out and make them into zero. It also allows us to update our capital when we're looking at our drawings. So it allows us to update those as well because we don't zero out how much we own of a company, but we need to make those adjustments. And an income summary allows us to do that. And an income summary as well, that special little account, it can be whatever it needs to be. It can be a debit or a credit, depending on which side the other account falls onto, whether it's to be a debit or a credit. So an income summary allows us to do those. So let's look at an example now. Let's look at revenue. So revenue is a good example. So let's look at the T-chart because these are the two accounts that you're going to be using, service revenue and income summary. But remember what we mentioned in previous videos, that debits have to go first and credits second. So it's important to understand why that happens. Why are we using service revenue first? Because if you look over on the LCRU chart, if we're looking at it, the revenue is on the credit side if it was a plus. So why is it on the debit side? Well, here's an example why. When you're looking on a T-chart, so let's assume our revenue was $2,000, right? Our original balance. In order to zero that out, we need to make a recording of $2,000 on the debit side, right? And in order to balance it out now, because we need to make it, because when we do trend left has to equal right? So we need to use the income summary account now that we just got introduced to on the right-hand side. So therefore, then you have debits first, credit second, or in this case, service revenue first, and income summary second. Okay? So let's move on to expenses, and let's see how that works out. So exact same thing like we did with revenue. If you look at expenses increase on the left-hand side, right? So if we have a lot of expenses, so if we look down in our T-chart, using this example again, our balance was say $2,000 when we added up all our expenses. In order to zero that out, we'd have to make a recording of $2,000 on the right-hand side. So that would be a credit. So that's why it gets recorded second here. But in order to make that recording balance, right, we need to use our income summary account and make a recording of $2,000. So therefore, income summary is a debit because it's on the left-hand side. So it goes first, and then our expenses go second. All right. So it's helpful when you're using the LCRU chart over here, again, just as a quick reference so you don't get lost. All right. So let's look at income summary. So income summary is exactly that. Is when you think about income, it's how much money you've made or how much money you lost. So when you're looking at income summary, you're looking at two possibilities. You can either look at a net income or you can look at a net loss. So let's first look at net income summary. So when you're looking at net income summary, there's two accounts that affect is your income summary and capital, right? So when you're looking at income summary, when you look at, say, because income is revenue minus expenses, right? So revenue is, say, in this example, is $4,000, and our expenses was $2,000. So did we make money? Yes. So it was a net income. So in order to balance that out, right, we now would have to use income summary as $2,000. So that's why income summary goes first. And why does capital go second? Well, capital just increased because we look at the LCRU, right? Because we've made more money, so we own more of the business. So our capital went up in the business. So that's why you have the two accounts. And capital is on the credit side because it's on the plus side. So it would go second. So income summary first because it's on the debit, capital on the credit side according to the LCRU chart. All right. So let's look at what happens if there was a net loss. So when you look at the two accounts, again, it's capital and income summary. So we know that in income summary, so if we use the T-chart, so revenue, so in this case, say we made $4,000, but our expenses were $8,000, so then we're at a loss of $4,000. So in order to balance that out, so we need to balance the left equals right on the T-chart, right? We need to use our account income summary of $4,000 so that it balances out, right? So it's now balanced. So remember, we need to make it down to zero. So the challenge that we run into then now is because now capital, right, it decreases because we don't own as much anymore because the company lost money. So debits go first, so hence why the capital goes first, and then income summary second because of down in the right-hand chart we need to make it balance. So the debit goes first because capital is a minus over in here we're on the debit side. So that's why we use the capital account first and then income summary. Okay? So don't worry, we're going to get into using examples and we'll do that in a bit. But the last one we need to do is drawings. So when we're looking at drawings, we need to look at, so say we withdrew money all year. We need to understand that we need to zero that out, right? So we're going to clear it out for the end of the year. So in order to that, we need to switch it. So for the T-chart, we'd move it over to the right-hand side, so the credit side. So it would be a minus, right, according to our LCRU, right? And in order to do that, it also affects our capital. So because left has to equal right. So capital would go down. So it would be in the minus. But because debits go first, credits go second, capital account goes first because it's on the left-hand side, right? And our withdrawals, because we had to zero that out, now, so capital gets updated, but our withdrawals now get zero because it's a new year. All right, so let's go through an example now and see how we do. All right, good luck. Here's an example where we have journalized some balances, some adjusted trial balances that we need to start making for the year end because we need to zero some of these temporary accounts out. So remember the example that we've covered. Acronym, read, okay? So that's what we're going to look at first. So let's look at revenue. So the two accounts that we're looking at where we're doing revenue is revenue, right? And income summary because we're using that account to zero it out. So let's find out what our revenue is. So let's look at some of the accounts that we did. Service revenue right here. Perfect. So we know that's the first account. So this would be service revenue. Right. And here, because it was revenue, it was a credit because it was on the plus side. So I'm actually just going to write over here LCRU again just to have it for us as a reference. You guys should know this off by heart now with no issues. Perfect. All right. So if we had a service revenue, in this case it was a positive because multiplied, right? It would be here, so it would be on the left-hand side. So in order to zero that out, it has to go over onto the left-hand side, right? Because we need to minus the same amount. So it would be a debit, and we do debits first, right? So 5280. And now we need to use our income summary, our new account that we just learned. Just use income sum for short. And because we need to make this balance, It's 5280. All right, perfect. So let's look at expenses. So what are the two accounts that we're using with expenses, right? So it's income summary would be one. Income summary is first, right? And then your expenses. So our income summary, we know, so we can write that in if we want. Just to make it clear, we don't make any mistakes. And it's helpful in this example here that you can see that it's indented, so we know that these are going to be all the expenses. So if we were to carry those all over, let's see what expenses they are, because right now we don't know what this amount is yet, because we need to total all up our expenses, right? Because we need to zero our expenses out for the year. So let's look at them. So here they all are right here. So let's tally those up. So we have depreciation expense. That's 470. Insurance expense. And that's 280. Interest expense. And interest expense is 110. And then rent expense. Rent expense is 560. And then last but not least is telephone expense. And it's 250. If someone has a calculator, you can quickly add those up. And those would equal, check my numbers, 1670. So in order to zero that out, right, we have to take that into a minus, or decrease it, sorry. So our income summary account in this case will be 1670 on the debit side, because debits go first, right? Because keep in mind is that when we're recording these on the closing sheet, expenses would normally be over here, but because we need to minus them out to make it zero, they go over on the right hand side. So now that we have them on the right hand side, we need to balance it out or make it zero with using the income summary. So now it becomes 1670. All right, perfect. Let's move on. So income. So remember, income, we have two options. It can be either a net income or a net loss. Most cases, hopefully, it's always an income, and it would tell you here if it was a net loss. But let's have a look and see if we find anything here that resembles it for us. So we don't, but what we do know, right, is for income, it's revenue minus expenses, right? Well, do we have revenue? We do. It's right here, 5280. And do we have expenses? We do. We know what they are right here. So these are expenses. And if we did the math, revenue minus expenses, you should, right over here, revenue minus expenses, should give us a positive number of 3,610, right? And it's a positive, so therefore it's a net income. So we know that we can use the net income example. So in that case, income summary comes first. And what's the other one that we use? Capital, because it gets adjusted, right? Because we've made more money, we actually own more of the business now. So if we look at the income summary now is 3610, because if we own more, it increases on the right hand side, right? But we need to balance it out using the income summary. 3610. All right. And the last one is drawings. And the two accounts that we talk about is capital and drawings. Right, so if we've taken more money out through our drawings, it will adjust whether the company has made, or the more that we own more of the company. So we need to make those adjustments finalized so that they get updated for the new year. So we know this is capital. And we know it's drawings. Remember, we're just updating drawings. So when we look at Natalie's drawings in this example here, $870. So why does it go on the credit side? Well, if we look at drawings, right, if it was over here is where it was, right, we need to minus it out. We need to make it 0. So that's why we need to bring it over here. But in order to balance it out, right, we know that it actually owns, we withdrew more money. Our capital has gone down, right? So we don't own as much as the company anymore. So it would go down. So debits go first. So hence, capital goes first on the debit side. All right. Okay, so now that we've finished all our closing entries, we need to make sure we haven't missed any. So we're going to do some little checks. We're doing a trial balance report or post-closing trial balance report to make sure that we haven't made any mistakes before we get ready to ship off to the tax man. So a trial balance report is used to just double check and make sure all accounts have been reset to 0. That was the overall, that's the intent, so that we're ready for next year, right? So step 1, in order to create the report, we need to carry over all the accounts that we have done for the year, with the exception of capital. Capital we need to update because the carryover ones, some carry over and some have zeroed out, so we're going to move those over. And except for the capital we need to adjust, right? Because we could own, or we don't zero it. Going into the next year, we still own or own more or less of the company, depending on the sales of that year. So we're going to update it. It never gets zeroed out. We're just updating it. So let's look at that a little closer. So here's capital. So our closing capital for the year is a certain number, depending on how much we own of the company. And then our drawings, which would be minused out of it, were taken out. That would be part of it. But now we need to adjust it, right? Because our drawings is going to be zeroed out, so we need to make it accordingly. So depending on what our income is, whether it be a net loss or a net income, depends on whether it goes on the left hand or the right hand side. All right. So let's look at that now. Example. So remember I said it was step number 1 is we're going to carry over all of the accounts, right? So let's just carry over the accounts. So cash is 7,000. Accounts receivable is 190. Right? Because these would carry over for the end. Remember, this is for at the end of the year. So these would carry over. So it wouldn't be zeroed out. So that's why we're just carrying them over. Because people are going to still pay us down the road. Our prepaid insurance might still carry over depending on when we purchase it. Right? It doesn't zero out at the end of the year. Our office supplies doesn't zero out, right? We still have pens. We still have all the paper. So that gets carried over. Our equipment, obviously, we still have. Right? That isn't zeroed out. Our cumulative depreciation, does that change? No. So that continues. $250. Our accounts payable, are we still going to have to pay our loans and everything else? Absolutely. So accounts payable, 1020. Interest payable, 110. So all we're just carrying them all over, all with the exception of capital down here at the end. So we just carry those over. So 1880, and our bank loan, which was 2820. All right. So now let's get to our capital, right? That gets adjusted. So let's look at it on a T-chart. It might be a little bit easier to see it better. So we see what's going on. So capital. And capital, as we know from LCRU, right, is a minus and a plus. Okay. So we know that our current capital from here is 13,670. Right? But we also know that there was drawings. So Natalie has some drawings of 870. So that goes on the right hand side. Remember when we're looking at withdrawals, right? So it directly impacts it. So depending on whether it's a net income now, we need to know whether it's a net income or a net loss, depending on which side it would go. So we know that it was a net income. If you look back at the video previously, we know that we had an income of 30,610, right? So we know that's how much money we did when we did the income summary with regards to net profit, because this was a net income, right? And if it was a net loss, it would have been over on the right hand side. So if we add this side up, because we know just at quick glance, we know this doesn't balance, right? Because we know that left has to equal right. This number here would be 17,000, I believe, 17,280, right? So we know left has to equal, so this has to be on both sides. So all we need to do now is subtract 17,280. We need to know the difference that we need to add these two numbers up. Minus 870. And that will give us 16,410. Yes. Right. So that would be the amount that would go here. Okay, so this is the amount that we need to record because it's on a credit. Because it's on this side, right? We need to zero it out or adjust it accordingly. So in order to do that, the adjustment would be on the credit side. 16,410. All right, and that's how we came up with that number there. So now we just need to summarize them all up, and if we add up all these numbers here, you should get 22. Sorry, let me fix that. So you should get 22,490. Now the total up, and we're making sure that it balances because left equals right. 22,490. And we're all good. All right. Hope that helps. Good luck.